For decades, owning a home wasn't just a lifestyle choice, it was a financial strategy, a retirement plan, a wealth machine, a sure thing. But something has changed. Prices have now fallen more than any other time in Canadian history. And today, I'm asking a question most Canadians probably thought they would never hear. Is the era of guaranteed gains in real estate over? Since the peak in February of 2022, average home prices in Canada have dropped from $837,400 down to $691,600. That's a 17.4% decline. But when you adjust that for inflation, you're looking at a 23% real decline, more than we saw in the 70s and in the 80s. That's not just a dip, that's $940 billion in home equity wiped off the map. It equates to the largest real estate equity loss in Canadian history, and it's shaking that core belief that real estate can only go up. And it's creating a shift in the mentality towards housing equity that ultimately may turn out to be a good thing. Because this housing price drop has Canadians questioning their faith in real estate as an infallible asset incapable of depreciating. We've already witnessed the immense pullback in real estate investing in this country, with the most popular asset being new construction condos seeing an absolute collapse in sales volumes to the tune of 95% decline in Toronto and around a 50% drop in Vancouver. As money flows out of investment properties and into other investment platforms like stocks and businesses, it could result in more homes becoming available for people to buy instead of rent. Canadians have already started to focus on other investment vehicles to fund their retirement, as home equity appears to not be the multi-decade safe haven that it once was. Going back to 1990 and all the way up to the end of 2023, home prices rose from $120,000 to $827,100, achieving a remarkable average annual increase of 6.3%. It was this relatively consistent growth for over 3 decades that essentially led Canadians to believe that that asset class was bulletproof. It was a time when countless Canadians became real estate believers, pouring their savings into the market and viewing their homes not just as shelter, but ultimately as their retirement plan. A speculative mindset took hold, fueled by the market's multi-decade resilience. While the US housing market collapsed during the global financial crisis, which was driven by subprime lending and reckless mortgage securitization, Canada largely sidestepped that fallout. As home prices soared, Canada gained a global reputation for having one of the most overvalued real estate markets. But each time a crash was predicted and then didn't materialize, confidence grew. And more Canadians were drawn in by this promise of ever-growing wealth thanks to real estate. With that incredible 30-plus year run-up in prices, the wealth effect was in full effect, with Canadians feeling richer than they actually were and ran out to purchase vacation properties, investment properties, and homes that were ultimately more expensive than they could really afford. And this was happening all across the country. The wealth effect, for those not familiar with it, is a behavioral economics concept suggesting that when people feel wealthier due to increased asset values like their stocks and of course real estate, they tend to spend more, even if their income hasn't changed. Conversely, when those same asset prices decline, well, their spending decreases. This phenomenon influences consumer behavior and can impact the overall economy. Let's take a look at how much that wealth effect has turned. As of Q1 2025, Canadian households and businesses held approximately $9.78 trillion in non-financial assets, the majority of which is in residential real estate. Typically, around 60% of non-financial asset value is in residential real estate. Based on all this information, the total value of residential real estate in Canada is estimated to be right around $6 trillion. Looking to StatsCan now, they state the average amount of equity in a home sits at 74%, placing the total amount of equity within residential real estate within Canada at $4.44 trillion. As mentioned, that was 2025 valuations. When we look back to the peak market of Feb 2022, that was, of course, before that 17.4% decline, placing the home equity then $5.38 trillion, which equates to a $940 billion loss in equity. When we experience such a dramatic change in a marketplace, when we see $940 billion erased from an equity landscape, when we see prices drop more than history, it starts to shift people's mentality and their focus and outlook on the changes that might be in front of us when it comes to real estate. So here's the big question. What if home prices just stayed flat for the next 10 or even 20 years? That would result in a generational shift on how people view housing. Younger buyers may no longer see housing as a shortcut to wealth. They may save less aggressively for down payments, explore other investments, or rent longer, not by necessity, but by choice. And that might not be such a bad thing. We could also see things like more supply, right? It would free up as investment properties lose their appeal. More diversified portfolios as Canadians put retirement money into stocks or businesses. And we could also see a shift toward treating homes like what they were always meant to be, a place to live, not necessarily a ballooning asset. Now, don't get me wrong. In a world where home prices remain stable, there are still ample reasons that people would want to buy, even beyond the obvious practical benefits. Homeownership offers stability that renting can't. It acts as a form of forced savings through regular mortgage payments. And ultimately, there would be a time when the home was paid off, whereas those choosing to rent only would see rental payments for the rest of their lives. But when it comes to pure investment performance, real estate may not act as strong as it has historically. Taking a long-term view, since 1980, the average Canadian home has appreciated at an annual rate of 5.5%, according to the Canadian Real Estate Association. Meanwhile, the S&P or TSX Composite Index with reinvested dividends has delivered 8.9% annually over that same time period. That difference is massive. A $100,000 investment in the average home would be worth around $1.1 million today. But that same amount in the stock market, nearly $4.8 million. Of course, this is an oversimplified example. It doesn't factor in regional real estate trends, property types, or taxes, right? For instance, profits from the sale of a primary residence in Canada are generally tax-free, unlike stock market gains. But real estate transactions also come with hefty fees and commissions, whereas broad market index funds can be held with minimal cost. And this isn't to say you should completely abandon home ownership in favor of stocks. The real point is this: viewing your home as a purely investment vehicle, well, maybe that is a flawed strategy. Because as we are witnessing today, that mindset led many Canadians to overextend themselves financially, underinvest in other asset classes, and rely too heavily on home equity to fund retirement. And that's a risky bet. A home can be a great asset and a source of comfort and pride, but it may not be the guaranteed investment vehicle that it was once made out to be. It's important to point out here, and as I outlined in depth in my previous video, the wealth gap between homeowners and renters is not only immense, but growing. It's upwards of 43 times difference now between renters and homeowners, and really demonstrates the economic divide that being a homeowner historically has provided. So while I can point to these charts that show that obviously investing in the stock market can provide higher returns on average, it doesn't mean that renters are ultimately adopting that strategy. It ultimately shows that if you're able to take that entire housing investment and put it into the stock market, the returns appear to be much higher. Now, this isn't an argument against homeownership. A house still offers stability, security, and forced savings, and especially for families. But as a primary investment vehicle, it may no longer be the best bet. Now, for those who are diehard real estate investors, there are still incredible ways to deploy capital within this industry and expect a solid return, including construction financing, multiplex buildings, building storage units, investing in modular construction technologies, purpose-built rentals, revitalizing distressed strata buildings, and so on. The danger is this: too many Canadians over-invested in particular real estate assets and ignored other wealth building tools. And now, with prices softening at a record rate and inflation biting, some people have become overexposed and vulnerable. In summary, we may be witnessing a generational shift in how Canadians view home ownership, not as a get-rich vehicle, not as a retirement plan, but as one piece of a larger, more balanced financial future. And maybe, just maybe, that is a healthy shift. Thank you so much for watching. I hope you found today's episode helpful. If you are curious what your real estate portfolio might be doing to your bottom line, reach out, let's have a chat. I'm a real estate investor with over half a dozen properties in the west coast of Canada, and I've been seriously analyzing my strategy and my portfolio's worth and maybe where that capital could be better deployed. Let's connect, no pressure, no sales pitch, just an honest conversation where I might be able to help provide some answers as to what can help you and your family's future. Feel free to reach out anytime. My contact information is below. Thanks so much and take care.